Hello guys, it's Chris from TheTradingExchange.co.uk, and this is the next in our series of videos for technical analysis. And today we're going to take a look at moving averages. Okay, so moving averages, there's a number of different options that are available for moving averages. Lots of other indicators use moving averages as part of their calculations. So having a basic understanding of this would really help. So we're going to take a look at really only two types of moving average, which would be the exponential moving average and the simple moving average. One's called EMA and the other one is called SMA. You might have heard them called that. Okay, so just to get started without any sort of basics, right in front of me here I've got just a simple DAX chart, and we're going to take a look at applying some moving averages to this. Okay, I'm using DAX just simply because it's the market I tend to trade most often. Okay, so the long and short of a moving average, what actually is it? Well, in front of us you've got a candlestick chart, and you can see these, our price action is really monitored based on the movements of these candles. And a moving average is really just designed to help us understand or smooth out the movements into a simple line. So we can keep all of the individual data and all the granular stuff that we can see inside these candlestick charts. But the line that the moving average is going to draw will just represent a little bit more smoother trend, perhaps, to see what's going on. Okay then, so a moving average is worked out simply by adding up all of the data of the previous candles. So for example, if we did a 5-period moving average, okay, 5-period moving average basically just means it will take the previous data from the last 5-minute candles, so the close, for example, of the last 5 candles, add them all together and divide them by 5, and it would plot that number there. And it would have done it the previous candle and the one before that and the one before that, so it would have taken the last 5 periods of data and taken an average of all of them, plotted them together, and then smoothed out a line. That's pretty much all it is. And so every single candle that updates, the line will change, because a new period of data would have deleted the last one, replaced it with a newer one, and it would just be a rolling average. Okay. So there are two types of average. You've got the, I'm just going to bring up the indicator window here by pressing I. And so you've got two types of moving average. You've got an EMA, which is the exponential moving average, and the SMA, which on this one is going to be called MVA. Okay, simple moving average. So simple moving average is what I've just done. If you've got 5 periods of data, you add them all together, you divide them by 5, that's it, done. An exponential moving average is very similar, except it just gives extra weighting to the most recent point. So the 5th candle, 5 candles ago, that one will get slightly less importance than the one that's just closed, that's just finished. So it kind of weights it a little bit more towards the nearest candle. I personally prefer to use that one, but it doesn't really make too much difference if you're just getting started. Okay. Excuse me. So let's just draw a chart on here. Excuse me. I'm on a 5-minute chart on the DAX at the moment, and I'm going to pull together the default moving average for FXCM's market scope. It just so happened to default to 10, so we're going to do a 10-period moving average. It's in sort of grey colour, single solid line, and there you go. That's it. That's the moving average right there. It plots over the candle data, and it just shows you roughly what sort of trend you might be in. So at the moment it looks like we're kind of bullish, or have been intraday since like 10 o'clock this morning. But overall, I mean, really it's kind of quite flat, not doing a great deal. So what would you use a moving average for? Well, on its own, a 10-period moving average doesn't really tell you a great deal that you can't already see yourself with your own eyes. It's just showing us that we went up and now we're going sideways. It doesn't really give you a great deal of information. What's really useful with a moving average, though, is to use a higher period moving average. So, for example, at the moment we're using a 10-period. There's not a lot of data that it uses. But if you increase that to, say, a 100-period moving average, it takes into account a lot more data to calculate the line. So it gives you a better indication of what the trend is doing. So as you can see, we've been fairly bullish here. By bullish, I mean that we've been in an uptrend, and price has been rallying. Whereas this sort of period here, all throughout the day of yesterday, that was pretty much a horizontal line. And as more data comes available, these lines will often change. And the way that you would use this kind of moving average is you would think, right, well, if we're above this line, then I'm really looking to get into a buying trade. You know, do I want to go long? It's suggesting that the trend is bullish, so let's go and buy the market. And maybe I'll try and buy the market when it gets a bit closer to the line, because the further away from the line it is, the more stretched it is, and you know, you might not get a good opportunity to make any money. So in this case, if you wanted to say, right, well, we're definitely bullish because we're above this line, let's see if I can buy in around here, sort of 96.90 to go long. Another thing you might do is, okay, well, if I cross below this line, I'm going to go short. And you might just simply trade it that way. And that would be good, because generally when you tend to take out and change the trend, it's at the point you've reversed. And if you can get in at the right time in a reversal, you can make a lot of money. On a market like the DAX, a reversal can be hundreds and hundreds of points. And at £2 or £3 a point, you can have a couple of days off if you need to. So that's how you can use a single moving average to trade it. Now, once you've added a moving average on, how would you go about changing the data you've put in there? So, for example, I've put in a 100 period moving average, as I can see when I hover over it. I don't know if you can see that little dialog box. I don't know if it pops up on the video or not. Or otherwise, you can look up here if you've got a legend, and it will look for the line. So the grey one, EMA, German 30, so DAX, 100 period moving average. So you can either double click that, or you can double click the line, and it will allow you to bring up the dialog box. This is where you can change your data. So you can change the color by clicking on the option there. Color palette, your choice. Number of periods you can change. The thickness of the line you can change. So if you want a really thick line, okay, can't do that. I can do a 5, which makes it simply a nice thick line so you can easily see it. You can change the type of line. And with moving averages, I mean, they're pretty basic. They're just lines. You don't need to do a great deal with them. They're just there to guide you. So let's just say we've gone with that. It's quite contrasty, but it shows you where it is. Okay, so another thing you can do with the moving average is you can use it to predict changes in direction, or use it to show you changes in direction to perhaps look at entries and exits into a trade. So if I just kept that one there just as an underlying trend indicator, so we're bullish at the moment, so perhaps we're thinking, right, we only want to go into trades that are going to be long. Okay. What you then might maybe want to do is have a look at a faster moving average. So for example, let's go with something like 8. Okay. And we'll just say, okay, why not? Add that in there. You might, for example, want to trade when the moving average, thinking 8's probably a bit too fast, actually. I might change that. So recite the Fibonacci sequence, because I just tend to use the Fibonacci sequence to choose my moving average numbers. So the next number up from 8 in the Fibonacci sequence is 13. Next one up from that is 21. Next one up from that is 34. Let's just go with 34, just for the sake of an exercise. Okay. What a lot of traders will like to do is they'll use these two different types of moving average. It might not be the 34 and the 100, it might be any other combination, but they'll perhaps take these two moving averages and they trade it when it crosses. Okay, now, difficult to show you an example of that at the moment because it's a bit cluttered and yesterday was a terrible day. So let's just change the market. Let's go to one that's hopefully had a bit of movement recently. Let's see if gold has done anything recently. All right. So there's an example. Okay, you've got a cross that happened somewhere around there. You had a cross, again, I've made one line thicker than the other. It's difficult to see if this was a cross or not. But let's just say this was the area we got in, and we went, right, okay, well, the faster M8, moving average, crossed below the slower one, this 100 one. That's where I got in, so I want to sell there. It worked out in this case because we could have got out there for a couple of dollar move, but you've sort of missed the move already, really. So it takes a little while for it to catch up. And that's because a 34 period moving average and a 100 period moving average is quite slow. It takes a while for it to actually sort of catch up. It's a little bit arthritic, a little bit old and doddery, and it just takes a bit of time. So what you can do is you can use faster moving averages. So I'm just going to go with two really fast ones. So 5 period, for example, and 13 period. 2 Fibonacci numbers once again. I'll just make one a little bit thinner actually, because that is a bit thick. And you would trade it much the same way. So you would trade when you get a cross. So for example, that cross that happened earlier on around about there, on the previous example, is actually now here. So the trade would have been a lot better there because you could have caught this move. So as soon as that crosses, you're entering. And you can see a few examples. There's a cross about there to go down, so sell that move. Cross to go there to go up, buy that move. Looks like we're trying to make a cross here actually for it to go down, so you'd be selling that. Be interesting. But that gives you an example. Okay, you might not want to trade all of these moves because ideally if you're not in a trend, you're just going to get chopped around and it will just go around and around and up and down. You'll just get chopped about. So you really want to be doing that in a trend. So if the trend is going up and you've all of a sudden just found that the moving average is crossed to the upside, then you can buy that. If you're in a downtrend and you get that signal there, then you can sell that. And it just adds to the probability that the trade's going to work and it's going to earn you money. Because that's really the bottom line. You want to get yourself into trades that are going to make you money. You need a few of them a day. Earn you however much you want to earn in a day, and then you're done. So the moving average tool is really useful to make really simple trades, and don't overthink it. If you're in a good trend and you get the signal from the cross on the moving average, then trade it. But we'll go into more detail on the trading application of these kinds of things a bit later on in another video. That just shows you how to apply an EMA to your MarketScope charting platform. Hope that helps, guys. Good luck trading, and I'll be back with another video.